Hey everyone, and welcome back to the channel. Today, we're diving deep into a question that has been on every silver investor's mind. With prices hitting multi-year highs, who is silently selling silver at the top? It's a fascinating puzzle. On one hand, you have a tidal wave of bullish sentiment. Retail investors are stacking, convinced that silver is headed to the moon. We hear endless talk about industrial demand, the green energy transition, and its role as an inflation hedge. The narrative is strong, and for good reason. Silver's fundamentals look incredible. But here's the twist. For every buyer, there has to be a seller. And when prices spike this dramatically, you can bet that some very big, very smart players are taking profits off the table. But who are they? It's not the small-time stacker selling a few ounces. We're talking about large-scale selling, the kind that can put a cap on a rally, even a powerful one like this. So let's peel back the layers and investigate the likely suspects. First up, let's consider the miners. This might seem counterintuitive. Aren't mining companies the biggest cheerleaders for high silver prices? Yes, but they are also businesses with operational costs, payrolls, and expansion plans to fund. When silver prices surge, it's a golden opportunity for them to lock in profits and secure their financial future. They do this through a process called hedging. A mining company might sell a portion of its future production at today as high prices using forward contracts or other derivative instruments. This guarantees them a certain price for their silver, even if the market pulls back later. It's a prudent business move. They aren't betting against silver. They're de-risking their operations. Think of it this way. If you owned a factory that produced widgets and the price of widgets suddenly doubled, wouldn't you want to lock in some of those profits to ensure your factory stays open and can even expand regardless of what the price does tomorrow? That's exactly what miners do. It's not a secret conspiracy. It's just good business sense. So a significant portion of that selling pressure could be coming directly from the producers of the metal itself. Next, we have the industrial users. Companies in sectors like solar energy, electronics, and electric vehicles are massive consumers of silver. They need a steady, predictable supply to manufacture their products. A rapid price spike is actually a major headache for them. It increases their cost of goods sold and can squeeze their profit margins. To protect themselves from this volatility, many large industrial corporations also engage in hedging. They might buy silver in the futures market to lock in a price for their future needs. However, if they have existing stockpiles that they purchased at lower prices, a major price run-up presents an opportunity. They could sell some of their physical inventory into the market at a profit and replace it later with futures contracts. Or, if they see prices getting too frothy, they might temporarily slow down their purchasing, waiting for a pullback. This creates a pocket of reduced demand, which, in market terms, has a similar effect to active selling. They are a huge and often overlooked force in the silver market, and their buying and selling patterns can create significant resistance at higher price levels. Now, let's talk about the big fish, the institutional investors, hedge funds, and bullion banks. These are the players often referred to as smart money. They operate on a completely different level than retail investors. While we might be buying a few hundred ounces, they are trading in millions. These institutions often use sophisticated algorithms and trading strategies. They might be long silver as part of a broader commodity play, but they are not emotionally attached to the silver to the moon story. For them, it's all about risk, reward, and profit targets. When a market runs up parabolically, their models will signal that it's overextended and due for a correction. Taking profits is a fundamental part of their strategy. A hedge fund that bought silver at $25 is going to be very tempted to sell at $35, realizing a handsome gain for their investors. They aren't necessarily bearish on silver long term. They might be planning to buy back in on the next big dip. This is the classic buy the rumor, sell the news, or in this case, buy the dip, sell the rip. Their selling can be a major force that stalls a rally in its tracks. And within this group, you have the bullion banks, the market makers. Their role is complex. They facilitate trading for clients, but they also trade for their own accounts. They are famous for holding massive short positions on the COMEX. Now, the narrative you often hear is that they are trying to suppress the price of silver. And while their actions certainly can have that effect, their primary motive is profit. When they see a massive influx of speculative long positions from retail and smaller funds, they are often willing to take the other side of that trade. They sell futures contracts, creating a paper supply that absorbs the buying pressure. They are essentially betting that the price will eventually revert to the mean. When the price gets high enough, the pressure on their short positions becomes immense, but it also becomes incredibly profitable for them if they can trigger a reversal. A little bit of selling from miners, a little less buying from industrial users, and some profit taking from funds can be all it takes to turn the tide. Once the price starts to fall, it can trigger a cascade of selling as leveraged long positions are forced to liquidate, and the banks can then cover their shorts at a lower price for a massive profit. It's a high-stakes game they've played for decades. Finally, we can't ignore governments and central banks, although their role is more opaque. While they are not major day traders, some countries do hold strategic stockpiles of silver. If a nation is facing economic difficulties or needs to raise capital, selling off some of its precious metal reserves at a multi-year high is a logical, if not common, course of action. This type of selling is harder to track and usually happens quietly without big announcements. It's not likely the primary driver of selling pressure, but it's a potential source that exists in the background. So, to sum it all up, the question isn't about one single villain secretly dumping silver. It's a confluence of different rational actors all responding to high prices in a way that benefits their own interests. You have miners de-risking their future production. You have industrial users managing their costs. You have hedge funds and institutional investors following their profit-taking strategies. And you have bullion banks playing the high-stakes game of market making on the futures exchanges. Each one contributes to the selling pressure that can create a top in the market. Understanding this helps us see the bigger picture. It doesn't mean the long-term case for silver is broken. The fundamental drivers of industrial demand and its role as a monetary metal are still very much intact. But it does explain why even the most powerful rallies face resistance. The market is a complex ecosystem, and for every enthusiastic buyer convinced the price is going higher, there's a seller on the other side, quietly and rationally taking their chips off the table. Recognizing who these sellers are and why they're selling is key to navigating the exciting and often volatile world of silver investing. Thanks so much for watching. What are your thoughts? Who do you think is the biggest seller at these levels? Let me know in the comments below. And if you got some value from this video, be sure to hit that like button and subscribe for more deep dives into the precious metals markets. We'll see you in the next one.